معرفة.
Bismillah ar-Rahman ar-Rahim. Now let us discuss about the third component of the financial screening, cash, and this in relation to total assets or average market cap. Cash in relation to total assets or average market cap. Let us again take an example. So this is a company, and for example, this company is having excessive cash, right? So this is flush with cash. Now the question is, in such a scenario, if this is an Islamic fund, can an Islamic fund invest in such a company by buying a share of such a company? The answer to this question is, we have to first understand the amount of cash which this company is having in relation to the total assets or the average market cap. So the basic guideline provided is that the total cash of this company, so meaning to say the total cash divided by the total assets of the company, should be less than 33%. So the total cash of the company divided by the total assets of the company should be less than 33%. So this is an important thing what we have to understand. The 33% part, the total cash part divided by the total assets part. Now, if we are taking the parameter as not the total assets, but for example, if we are taking the total cash divided by the average market cap, the total cash divided by the average market cap, again this has to be less than 33%. So again, in both the scenarios, whether we use assets or we use the average market cap, the striking point is that it has to be less than 33%. Now you may ask that what is the rationale that it has to be less than 33%? Why it cannot be more than 33%? And what is wrong if a company has excessive cash? As we understand, in today's financial markets, an investment in a company is done by buying a share of the company, and these shares are again traded in the secondary market. So from Sharia perspective, if an Islamic fund purchases a share of a company who has excessive cash, that is more than 33% of its total assets or more than 33% of its average market cap, then what it means is that this certificate is reflecting nothing but cash. And if this certificate is the underlying asset, the underlying feature of this certificate is just cash, so what will happen is that this certificate, when an Islamic fund purchases a certificate of a company who has excessive cash, okay, then what it means is that when this certificate is traded in the secondary market, it means that you are trading currencies. So the premium and discount is non-compliant, and hence to invest in companies who have excessive cash more than 33% of its total assets or average market cap is not allowed. Now let us discuss about the fourth financial screening, which is with reference to account receivables. Again, just to understand it better, let us take an example. So if this is a company, and for example, if this company is a real estate company and this company is involved in selling houses. So this company is involved in selling houses, and this is the customer. And this customer is supposed to make this payment. For example, let us consider that this payment is done over a period of 10 years. What is an account receivable? Account receivable is nothing but it is the money owed by the customers to the company. So the company has not received the whole money, but it is supposed to receive this money from the customer, either for the goods or in some other cases for services provided by the company to its customers. So this is something which is to be received, meaning to say it is not already received, but it is going to be received in the future. Now the question is that if that is the scenario, can an Islamic fund invest in such a company by buying the share of the company? Again, the simple answer to this question is that the account receivables have to be in a certain minimum level, and that minimum level again is in relation to what we have understood as the total assets or the average market cap. So the account receivables, so the total account receivables, right? The total account receivables divided by the total assets of the company should be less than 33%, right? And again, the total account receivable divided by the average market cap should again be less than 33%. The rationale here also is the same. That is, that the account receivable is a debt to be received. And again, a debt to be received cannot be traded on premium or discount. It has to be traded on par. But as we have purchased a share which is actively traded in the market, so if a company has excessive or more than 33% of account receivable compared to its total assets, or more than 33% of account receivable compared to its average market cap, then what it means is that you are trading in a receivable. And when you are trading in a receivable, the premium and discount will represent interest. Therefore, it is not allowed by an Islamic fund to invest in a company whose account receivables, do not pass the screening ratio, that is the 33%. And we have also understood the rationale for this.